Good afternoon. You're all very welcome to today's webinar, Finance Business Partnering, More Questions Than Answers. You will see the Q&A button on the bottom of your screens, and as all attendees will remain on mute for the duration of the webinar, you're welcome to input your questions here and Leonard will answer them at the end of the webinar. We will be recording this webinar and will provide you with the link via email after the session. We're delighted to welcome back one of your fellow members, Leonard Brown. Leonard has over 30 years experience in finance and general management roles, gained across both privately owned businesses and large corporates. He's a fellow of the Institute and has an MSc in Business Improvement and is founder and of coaching and online training provider Profit Analytics Limited. With this in mind, I'll leave you in Leonard's capable hands. Welcome, Leonard.
Hi, Jane. Thanks everyone so far for joining. What I'm going to try and do today is give you my view of finance business partnering and the role of the finance business partners as we're seeing it unroll in front of us. And over the course of the next 35 minutes or so, I'm going to look at what it is and what it aims to achieve. I'm going to give you, as I said, my view on where it has come from and whether or not it's something that's new. And I'm going to look at a couple of factors that may help explain why it's getting so much airtime in print space presently. Then I'm going to look at a few things that need to be thought through both by finance departments considering introducing finance business partnering and by would-be finance business partners. Finally, I'm going to make a few suggestions on how either an FD or would-be finance business partner might go about dipping their toes in the water to test the temperature before deciding on what's next steps to take. My plan is to work through the main body of this webinar, and then, as Gina said, I'll do my best to answer any questions that you have. I think that's the best way to go about it. And rather than telling you as much as I can about things that you may not be interested in, I'll give you what I see as the skeleton or framework of the topic, and hopefully by answering questions as best I can, I'll try to flesh out those areas that you're more interested in. Firstly, I've got to give you a health warning. What I'm going to describe over this next short while are my views on the topic. That's no way infers that those are CIMA's views or indeed the views of any other accounting body. So be warned. Okay, let's start with one of the definitions of what finance business partnering is, one that's in circulation presently, and as I see, explains a reasonable amount of what's on the go. So it says, the first thing that this tells us, it says work closely with the business's operations and management, provides them with real-time support analysis. The finance business partner is a trusted advisor, adds value by helping those they partner make better decisions. So if we break that down a little bit, the first thing it says is that it tells us who the finance business partner is working with. They're working with the operations and management. They're working with the doers and the decision makers in the organization. It's the people who make the decision and take the actions that impact top line, bottom line, and almost everything in between. Second thing they tell us is how the accountant works with them, and it says closely. It says that by working closely, it suggests sort of sharing thoughts and ideas rather than just passing something on. The third thing it tells us is when this support is provided, and it uses the word real time. In other words, when it's needed. It's not when the accounting calendar suggests there's a bit of time to do it. The fourth thing, it tells us what form of support that there is, and it goes, it takes the word analysis and goes beyond, in truth, what is from analysis into insight, as we'll see as we go on through this. Fifth thing is the finance business partner, according to this definition, is a trusted advisor. Now, what it takes to be a trusted advisor is a huge topic, and it's subject to many, many books. But what we do know is that it takes a long time to establish that status, but it only takes a few moments to destroy it. Sixth thing, it tells us why the role exists, and it says it sums it up in 2 words: add value. Now, if there's a second phrase that's, I'm sure you're seeing being used widely presently, it's got to be add value or adding value. And by precisely what that means and how it's measured is getting sometimes less clear. However, in this case, it's not in doubt. It says the finance business partner adds value by helping those they partner make better decisions. And in my book, how we know they're better decisions is because they produce a quantifiably better result. So perhaps a shortcut way of describing what a finance business partner is and does is they're a finance professional who uses their skills and their knowledge of the business to help their management colleagues produce quantifiably better results that they otherwise might have done without that help. Right, next I'm going to try and give you some idea where I believe the role title has come from and whether or not the role as opposed to the title is new. As best I can, the description business partnering and the role title of business partner, as I can see, were firstly promoted for the HR profession. And that was by Dave Ulrich in his 1996 book, HR Champions, or to give it its full title, HR Champions, The Next Agenda for Adding Value and Delivering Results. Now, I don't know if you know the name, but Dave Ulrich is Professor of Business Administration at the Ross School of Business in Michigan. And at one time or another, he's been described by Business Week as one of the world's top 10 educators in management and the world's top educator in HR. So he comes with a bit of a reputation. But although Ulrich will openly tell you he didn't invent the term business partnering, he's certainly someone who has popularized it. The model that you can see on your screen now is the original and perhaps the most popular one associated with Ulrich's business partner concept. It looked at HR's activities as fourfold: the administrative expert, the employee champion, the strategic partner, and the change agent. Ulrich said his aim was to help HR professionals integrate more thoroughly into the business processes, and as he described it, help them align their day-to-day work with business outcomes. But debates arose about which of the 4 roles was the business partnering role, and later he lobbed in a different 4 categories: corporate HR, embedded HR, HR specialists, and service centers. And there's a chance, to be honest, for some that just muddied the water even further. And some years later, he wrote, sometimes one of these roles is uniquely defined as business partnering, but in fact, each of the roles can be a business partner as they create value for employees, customers, shareholders, and so on. Roll forward 12 years. By December, or November rather, 2008, we were 12 months into the global recession that had started in December prior. HR Magazine published a review Ulrich had written that dealt with 2 key points: what had happened with his business partnering model during the preceding 10 years, and what lessons had been learned from using it during that period of time. Importantly, in terms of what we were talking about today, in that article Ulrich wrote, the business the business sorry, I'm just losing on the screen here. The need for greater business performance has put all support functions under a microscope, and they're all trying to find ways to deliver more value to either the top line growth or the bottom line profitability. If they're not delivering definitive and sustainable value, they've been given the mandate to either change, be eliminated, or be outsourced. And he continued, information systems, finance, legal, and marketing, and R&D are all under scrutiny and under pressure to create greater value for their companies. And it's especially true of transaction and administrative work, he said, that can be standardized, automated, or outsourced. So what I found interesting about that was that of the 6 functions Ulrich mentioned, 5 of them, information systems, finance, legal, marketing, and HR, have today all got role titles included in those specialities that contain the words business partner. The exception, I couldn't find any in R&D, and I'm guessing that's by the very nature that R&D is all about adding value one way or another. So is that where the role title finance business partner has come from? I can't be 100% sure, but I'm guessing it is. So if finance is under scrutiny and the pressure to create greater value for their companies, how might it do it? One illustration that, really an explanation that stuck with me, I guess, over the years is one CMA generated back in 2007. It's quite simple looking diagram, but it's one which packs a lot into it. It shows 6 stages from the point data is captured right through until the impact of something which changes as a consequence of it. Those 6 stages are data capture, reports, analysis, insight, influence, and impact. The pink area towards the bottom of the chart represents the value which is added at what originally started as data as it moves through each of the 6 stages. So it shows it being increased. The blue area, according to the thinking of its authors, is how comfortable the stereotypical accountant is at each stage of that journey. In other words, it shows it goes down. The purple area at the top shows how the skills needed for finance shift from technical to people skills. And what started as data turns into insight and is acted upon. So more people skills required at each stage. First 3 of that, excuse me, just one sec. The first 3 tasks, the data capture, reporting, and analysis, are what I think we'd all recognize as standard accounting tasks. They're happily within the traditional accounting comfort zone, if you like. They're primarily technical skills, and they add value in the terms of providing information. There are frequently emphasis on how efficiently that's being done. But for the last 3 tasks, or the run through insight, influence, and impact, the emphasis switches from efficiency to effectiveness. The diagram suggests the value added ramps up, but the comfort level of the stereotypical accounting professional dives as the skills needed move from technical skills to people skills or interpersonal skills. The first step of this development or progression is turning information into insight. So what do we mean by insight? I looked up a couple of references for it. The first said, the understanding of a specific cause and effect within a particular context. The second, the ability to have a clear and sometimes sudden understanding of a complicated problem or situation. So the insight that we're talking about here is the link between cause and effect. It's recognizing that in a particular set of circumstances, or when this and that happen together, the effect or outcome is whatever has been recognized, if you like. And once it's been recognized, the opportunity is to use that knowledge or recognition to improve performance and improve results. But that means convincing others, the decision makers, the ones who have the power to turn that new knowledge into action. And that's where the interpersonal and persuasive skills become necessary. Okay, so if we maybe have a bit better understanding of what finance business partnering is or is said to be, we've got to ask ourselves these questions. Is there something new? Is it something that wasn't being done before? Did finance people only start helping drive business performance sometime after the year 2000? I believe the answer is certainly not. For while the role title finance business partner may have only been used in the last 20 years, the role itself has existed in some organizations in one form or another much, much longer than that. In the November 2008 review I've just mentioned, Ulrich recognized that the HR professionals who had been able to lift and run with his model were the ones who had already been playing that role before he wrote it up. They'd already been doing it. And as I see it, that's the way it's been for finance too. There's evidence some professionals were playing that, what we call today finance business partnering role, 60 or 65 years ago. In fact, I was in that role full-time in a large corporate for 5 or 6 years, 30 plus years ago, but not with that job title. During those years, I didn't post a journal, I didn't reconcile a balance sheet account or prepare a set of management accounts. My job was to support a regional director and the managers of 7 businesses in his region. My purpose was to optimize profitability. And according to my role spec, I had to do that by using my analytical, interpretive, and influence and skills to encourage, persuade them to take what I believe to be the best course of action to deliver that result. It describes all 4 of those final factors. And so while business partnering may be a new title, it's not a new role. And it didn't just start with Ulrich's business partnering model back in 1996, or at least that's my view of it. It's been around for much longer than that. So if the concept isn't new, why does it appear to be getting so much airtime in print space now? What's driving that? What's changed or is changing? And I think 2 things have changed or in the process of changing in finance. The first is something I've already mentioned. The demands on the business have changed, and therefore the demands by businesses have changed. They can't afford unjustifiable cost in their support functions. And we've all seen, we've been both part of outsourcing and creation of what some term centers of excellence. But from a purely defensive point of view, it's important for finance that it can identify what it does to improve or protect the performance of the business, how it adds value. But it shouldn't just be doing that as a protection mechanism. Finance, as I see it, no, it is much bigger than that. It needs to be demonstrating both how it improves and that's how it can add value. Essentially, that's what the finance business partner role and aim is to do, to add value. The second reason I can think of for increasing interest in finance business partnering is for repositioning accountants as finance business partners when the incoming or oncoming of robotics and artificial intelligence. If rules can be written for something can be done, or if the action can be learned from a history of previous occurrences, then AI can do it. They can learn it and do it. And then they do it for 60 minutes in every hour, 24 hours a day, 365 days a year. Now, we know robotics and artificial intelligence will impact jobs, and the study was carried out in Oxford 2013, and it looked at jobs for the US and how susceptible various roles were to computerization. It estimated 47% of jobs were at risk of being automated within the next 20 years. That's then by 2033, 9 years from now. And it looked at all types of jobs as they're categorized in the US. They use what they call an SOC, or Standard Occupational Classification Code. There were 702 jobs in total. At the top end of that list was higher than a 90% probability or susceptibility of being computerized or replaced by AI, were a number of accounting and accounting-related roles. They included accountants and auditors, maybe see on the screen now, payroll and timekeeping clerks, bookkeeping, accounting and auditing clerks, plus what in the US are referred to as tax preparers. At the top end of the table, I've deliberately included a couple of roles rated as less susceptible. And the common feature they share, as I see it, is the personal interaction and communication required by those roles. So as accountants, given those projections, we should have an interest in repositioning ourselves, and it's obvious why professional accounting bodies should be interested in repositioning their members, both present and future. For if they don't, over time, if those research projections are anything like correct, it's reasonable to assume the number of human accounting roles will reduce, and so the membership of the professional bodies will reduce. If you've seen the IMI's humorous 30-second Robo Accountants video, you'll know what I mean. In the video, as the qualified management accountant walks towards the meeting room, robots are handing him various reports. When he arrives at the meeting room, a robot is sitting in his seat, but embarrassingly gets up to make way for him. The idea behind the advert is to highlight that qualified management accountants aren't competing with robots. The robots will produce the information for the qualified management accountant, and he or she will interpret and develop the insights from it. The switch from human roles to artificial intelligence will take time, and it will vary by size of business, but we've got to assume over time it will happen. And unless accountants reposition themselves to roles that aren't under threat, then membership of the various bodies is bound to reduce. So with the mandate from business leaders to change and a trend called artificial intelligence coming down the track towards us, as a profession, we've got to seriously look at what we do and what value we deliver. And finance business partnering is one way of doing that. Okay, so we've looked at what finance business partnering is, or is supposed to be. We've looked at where it's come from, or at least where the term has come from. And we're starting to understand at least a couple of imperatives for putting it to work. So what, if anything, is stopping us? Or put another way, what does an organization which doesn't already have finance business partnering working successfully will it need to think through and address? If this were a workshop, at this point, I'll play a short video. In the video, Justin Watson, a partner in Deloitte's UK consulting practice, talks about finance business partnering and explains his experiences and the experiences and perceptions of clients and other businesses they've surveyed. I'm not going to play that video today for time reasons, but I'm going to summarize the key points that come out of it. In the video, Justin Watson explains for a long time in many organizations, the focus of finance transformations have been on things like shared services, outsourcing, and process-based optimization, but things are changing. For many organizations, the shared services and outsourcing bit is done. Now they've turned their thoughts to what the finance organization retained within the business and what it could and should deliver. And business partnering has come to the fore. He goes on to explain when CFOs are asked what business partnering, what it is about business partnering, I guess, that keeps them awake at night, there are three recurring themes. The first is finance systems. It's an age-old issue, which he says keeps on coming back. To be effective and to make informed decisions, finance teams need credible information. But in one of Deloitte's surveys, over 60% of companies felt they didn't have systems that would allow them to deliver the information necessary for finance to support their business partners. I'll not say any more about that for the moment, but I'm going to come back to it. The second issue that really stands out, he says, is talent. Being a business partner requires different skills from those needed in finance's back office. To be a finance business partner, you've got to understand the business, the market it's operating in, and you've got to be credible, you've got to be articulate, and you've got to be highly proactive. And he says those aren't skills you find everywhere in finance organization. The third area he describes is really interesting. What apparently became clear from some of Deloitte's research was that around 40% of organizations said they weren't clear where they were creating value for their organization. That's 40% of the organizations they surveyed, of course. And obviously, that's a significant gap. So what does Justin Watson see happening? The first change he sees is the growth of analytics. And he says he's seen significant investments going into analytical platforms to help simplify the complex. The second change is talent. It's learning how to recruit, train, and manage the performance of people who have quite different set of requirements really placed on them compared to traditional finance team members. And the third change needed is to better understand where finance can help add value for the business. And that means having a really good understanding of the business in its entirety. So what do we learn from that? Have the right people in the right roles, understand the business thoroughly and be clear where in the organization finance can make the biggest impact, and make sure it has access to the information that will need to do that. I've got to say, I struggle a bit with that last point, the lack of information. I'm presuming there are very large companies we're talking about here that Deloitte have surveyed, companies with very, very large pools of data. And these organizations have frontline managers that are making business decisions every day. I can't help but wonder, could it really be true that, as a number of the CFOs suggest, they don't have any reliable information to base those decisions on? Are they just winging it? Or is there a chance that in some of the organizations, finance is using systems as a bit of an excuse? Finally, I've said I suggest how either a CFO or a would-be finance partner might go about dipping their toes in the water to test the temperature for finance business partnering in their organization or for themselves. And I'm going to quickly do that now. 7 steps to getting started in a business, trying to, towards the end of the introductory workshops that I facilitate on this, I encourage those who are either attracted to the role or to see the merit of it but who work in organizations where it doesn't yet exist, I suggest them that it's worth trying testing the water by setting up or taking on a pilot project. The process, I suggest them straightforward and adjustable, depending on whether the individual concerned is a would-be finance business partner or is an FD who feels their organization might benefit from it. It's only a handful of steps and it's deliberately kept simple. It's intended for small, medium, and large businesses, but where the business is large, depending on its size and structure, I usually suggest this pilot is limited to one entity within the business, if that's possible. The common steps are these. Step one, choose a problem that really needs to be resolved or an opportunity that can't be ignored. Make sure whatever's chosen has significant quantifiable benefits or resolves a recognized ongoing issue, and importantly, make sure it's something that can be celebrated and talked about across the business when it's completed. The idea of the project is to illustrate how either finance or would-be finance business partner can help the business's operational managers, help them improve the business performance, and encourage further take-up of the idea. It can't do that, of course, unless once it's done, one of the success of the trial can be openly talked about, if you like, within the business. Step two, set yourself a 90-day deadline for your project. 90 days is a reasonable time scale for a project like this. There's also a rationale behind it, which I won't go into presently. But by the end of 90 days, you should either have the improvement recommendations agreed and actioned, or at least recommendations agreed and in progress. If 90 days is genuinely too little time, the project scope is too large, it needs to be reduced. It's important to keep momentum, not to let things slide, and not to let the project scope of the project creep. Step three is to make sure it's something that can be tackled alongside either your or their day job. There might be other temporary working arrangements you could make, but for this purpose, let's assume there's not. If you're a would-be finance business partner, you'll already have a host of regular finance duties to get through and timetables to meet, so you'll need to create the capacity to take on the project. Likely that's going to need a bit of prioritization, a bit of delegation if that's possible, a bit of negotiation, and it's going to need a commitment from you to work extra hours where needed, I'm guessed. If you're an FD or a CFO setting up this project, you might be able to free up time for whoever you nominate for it, but be realistic and tell it like it is. Step four, decide what data you're going to need for the project and be clear where and how you're going to get it. If you're a would-be finance business partner, it's worth considering getting on board what Tom Peters used to call a CHRO, or Chief Hurdle Removal Officer, for when you hit a roadblock. Or roadblocks and hurdles do arise, and sadly often they're human. Step five, decide what knowledge and skills you need to be brushed up for the project, and often soft skills that need to be honed. Someone who's operating in a more traditional accounting role, a role where logic, standards, and right or wrong apply, doesn't get the same day-to-day opportunity to use their influence and skills. Remember, a brilliant analysis and really important insight won't improve performance if you can't sell the idea. And just because it looks like a no-brainer to you doesn't mean it'll fly. Step six, choose someone experienced, someone you trust to be a sounding board. It's very easy to get wrapped up in a project and go off down the blind alley, or put forward an idea which on paper looks good, but in reality is impractical or simply isn't sellable. Whoever you choose to be your sounding board shouldn't be the operational manager you're hoping to influence. And if you're a FD organizing the project for one of your team, neither should you be the sounding board. It'll be less embarrassing for whoever it is if it's not you. Step seven, in the words of Nike, made famous by Nike anyway, is just do it. That's how we learn. That's what produces results. In terms of what to do, my normal suggestion is, if you can, start with a benchmarking project. Benchmarking projects have many advantages at this stage. There are a handful of side issues that I'd suggest for the project, depending upon which of the two roles you're in, but rather than spend more time today discussing what might be of interest, if you want to talk it through, just contact me. So we've looked at what finance business partnering is and what it aims to achieve. I've given you my views as to where it's come from and whether or not it's new. I've suggested a couple of factors which I believe help explain why it's getting so much airtime in print space presently. I've very quickly overviewed some issues that need to be thought through, both by organizations considering introducing and by individuals who might be attracted to the role. And just now, I've suggested how either an FD, CFO, or would-be finance business partner might go about dipping their toes in the water to test the temperature before they decide on the next steps. Lastly, I'm going to wrap up with a profound few words from the sadly late Andy Shambrick. He said, anyone in finance, whatever their job title, can be a finance business partner. Having a job title, finance business partner, doesn't make you one. Not having the job title finance business partner doesn't mean you're not one. To me, it's all about what you do and how you do it. One final point. There are many, many reports out there on finance business partnering produced by various professional bodies, practices, and organizations. However, if after today's webinar you'd like to read more, if you haven't already read it, I suggest download the CGMA report, Finance Business Partnering, The Conversations That Count. It's not the newest report on the block, it's 9 years old, and it's not the largest or thickest. But within its 25 pages, there's a mine of information, references, basic learning, and common sense for someone seriously interested in the topic. And if you're wanting something else, there's another fairly easy to read report available presently from the Business Partnering Institute. Any LinkedIn users that follow finance related topics will likely be aware of Anders Lillenberg. Anders posts very regularly on finance business partnering and other finance topics, and he's a founder of the Business Partnering Institute. You might find the report useful. Now, let's go, I guess, to any questions, Jean, if there are any, and if we still have a linkage.
We do, yeah, of course, thanks. We have a two-part maybe from Gary. So, hi Leonard, in your opinion, what is the difference between a finance business partner and a departmental accountant?
Yeah, good question. I think it's not what, it's almost back to the Andy Shambrick. I'll just float back to that if I can for a second. It's not what you're called. It's effectively what you do. And I think we can get hung up on job titles. The question really is, does the departmental accountant get involved and try and push forward ideas to improve performance of the business? Are they involved in the way that we were talking about by trying to work when it's needed with individuals, having taken an analysis, turned it into insights, and then persuaded someone to follow through on that? So I'm not sure if that's, I think really the whole thing is, let's not get hung up on the names and job titles. Let's be sure it's the job, the role, and what we're doing.
Okay, because he kind of says then, is a business generally seen as still operating and reporting to central finance?
I'm not really sure, just is it seen as operating to central finance?
And reporting to?
Yeah, well, let's put it like this. When I give an example in this, Jean, when 30 plus years ago I was doing this role, I actually had two bosses. I had the finance director of the corporate I was working for, and I had the regional director of the region that I was providing this service for. So it was a matrix management style. So yes, you're still reporting to finance, and yes, you're reporting effectively in that instance. And I think most of these will be to the people you're supporting as well. Does that answer it?
Okay, I hope so. I've just said it to Gary though. If he wants more elaboration or if he wants to elaborate, he's welcome to.
Yep,
There isn't any other questions in just yet.
no problem.
Oh, there is. Sorry, one has just come in. So hi, Leonard. Do you think this could be a role performed by an external person or only by somebody already in the business?
Would the skills be possessed by an external person? Yes. But is it likely that they're going to know enough about your particular business? I guess if it's a very small business and they have a very tight finance team, they don't have the time, if you like, to take on this advisory role, this way of trying to push through ideas. Then they might decide that they bring someone in outside who's got those skills and experience. But I think it's going to be honest, less value. You can get people in on occasions to do one-off projects, as we all do, but the ongoing value is having the trusted person inside the organization, as I would say it. Somebody that can be referred to over a cup of coffee.
Oh,
Not
very good. Okay, yeah, I understand. Yes, I think Gary has just replied, so that answered he answered his question. Thanks. He said he's sorry he missed putting in partner after the word business, so business partner in the second question, so the finance before it. So you've answered anyway. You've kind of anyway.
Yep.
So thanks. One other coming in, please. Do you think that finance business partnering is already happening without it being called that? A
Yes.
managing director once described my role as that of a puppeteer pulling the strings. With a very good puppeteer, you don't even see the strings.
I think that's a very good summary of it. And again, if I can refer back to, the job spec which I was given was to try and persuade people to do what the data, the information, and the insights suggested was going to be best for the business. So I wouldn't dare have called myself a puppeteer pulling the strings of the regional director and the general managers who reported to him. But you could argue I was putting very strong suggestions and very good reasons as to why they should do those things. So yeah, that summed it up, I think, better than I could.
Very good. One other one coming in. In your opinion, is a service level agreement in a business partnering arrangement, I should say, more of a help than a hindrance? Have you ever come across an SLA in BP arrangements?
No, I haven't, is the simple answer to that. You know, when I've seen this work well, it's been non-contractual. It's because people get on and respect each other, and the operational or be it sales, be it general management, be it operations management, they don't look on the finance person who they're linking with as somebody who is the police force trying to keep an eye on everything that's been done. They look to them as somebody who understands the business almost equally as well as they do, and who is using the information which they have picked up in their finance role to be able to help improve that business, and then help them do their role. I mean, one of the tests that I've suggested in the past, if you do the role well, And if it's in a large organization and you do the role well, for the part of it that you're linked to, the manager of that part should be quite happy to take on your salary because you're earning it multiple times over by helping them perform better. So contractually, I don't think there's the work. I think it's what you do and the linkage there.
Okay, thank you. Martin says, thank you very much. And just a comment from Robert, who'd asked, or who had used the analogy of the puppeteer. He said he worked for you in a post that you mentioned, and you definitely had pulled some strings. So,
It's okay.
Another question for you, please, Leonard. If finance business partner roles more common in public or private sector?
I guess, when you look at the Deloitte example that I was giving there, I would imagine that many of the companies that they worked with and surveyed were PLCs. But the same need is still there in the private sector. In fact, you can argue that the likelihood that some of the operational managers in the private sector will have not had the opportunity to learn what some of the managers in the public companies will have, publicly quoted companies will have done. So I honestly believe, and I've seen it working in both privately owned and floated companies, and I've seen it working in companies that were small, medium, and large. It becomes more difficult in the small company because often the finance, it's has to be very tightly managed, not people-wise, but it works across as I see it, and I've seen it. Yeah.
Okay, thank you. Next one in, please, Leonard. How does this differ from the traditional management accountant whose job is to support the business in making financial decisions by interpreting financials from them and suggesting actions?
I think we're back again to what's in the name. The management accounting role is largely what I think this is, but not all management accountants have done and will do all of what is in this role because they either don't have time, don't see it as their role, or they're in an organization which doesn't accept that they would have enough knowledge to be able to suggest to an operations manager or director, or to sales manager or director, or to the MD, CEO, what should be done. So I think it comes down to choosing organizations as well. Is there, I when I'm doing this and facilitating a workshop, it would be, one of the tests would be, is it the right sort of an organization to be in? Is it going to happen? If you have a very dominant MD who likes to shoot from the hip, then unless you've got some good persuasive powers, you're likely not going to be able to make much of a breakthrough. If it's someone who values what you do, whether you have the management accountant role or whether you have some other title, then they're going to ask for an opinion, or they're going to accept when you go to them with an opinion and listen to you and perhaps debate, argue, whatever it may be. But management accounting to me is where this started, and certainly where I've seen it starting. Finance business partnering, as I sort of said at the early part of this, is a term which started to be coined around the mid to late 90s. And then finance and a number of the other professions picked it up from there. Does that answer? do you think?
I hope it will. I think it would. I'll wait and see if they come. Yes, thank you. It does.
Right.
It is.
Thanks.
Thank you. Thanks. And that's it from the questions.
Okay.
What I might do is just go and I think it is. I think it is, to be honest. I don't know if any further are coming in. Let me just share my screen then and do a final wrap up, if that's okay with you.
Yeah, in fact, I'm not sure whether my camera is still on or not, but it's not on my screen. So yeah,
Yeah,
but
I
I
can
can
still
see you.
see you. Yeah,
Can you?
no, yeah, I can. Yeah.
I'm luckier than you are then. Right, go ahead.
Brilliant. Thanks, Leonard. No, the questions have there hasn't any further come in anyway. So if you're happy to wrap up, then
Yep.
Leonard, that's brilliant. Thanks so much.
Okay.
Obviously, as usual, on behalf of CGMA Ireland, we'd like to thank you for the informative and really relevant presentation. We really appreciate your time as usual. Before we do go, we'd like to draw your attention to our upcoming webinar, Accounting Treatments for Cloud Computing and ERP Investments. This is the third webinar in our ERP series and scheduled for Thursday, the 11th of April at 1 p.m. We hope you can join us then. Obviously, I'll send the link for this, to register for this. I'll send Leonard's presentation and the recording of this webinar today as well in our follow-up email. And I'd like to thank you all for attending. Obviously, we hope you found it beneficial, and we look forward to seeing you again soon. Thank you all. Take care. Bye.